1980s, the IMF applied the Washington Consensus: raise rates, cut budgets, open markets, privatize. This suddenly good policy quietly led to a financial crisis that swept across the Asia. Hi, my name is Chris. Today we are going to talk about the Asian financial crisis. In the mid-1990s, East Asia was the world's fastest growing region. Then, in July 1997, Thailand and other East Asia countries dropped it into a crisis that reshaped global finance. Thailand, Indonesia, Malaysia, and South Korea have a strong growth rate. People call this period of time the East Asian miracle. High savings, export-led manufacturing, and foreign investment created the illusion that rapid growth was permanent. But the foundations were weaker than they looked. However, miracle becomes fragile. First, capital accounts were opened before regulators could monitor risk. Second, pegged exchange rates and free capital movement mean there's definitely no independent monetary policy. Third, firms borrow short-term dollars to fund long-term local currency assets. These may link back to the Washington Consensus we talked about. And this is related to the concept called hot money. Hot money loves a fixed exchange rate because it feels like a one-way bet. When George Soros and other hedge fund managers concluded Thailand's central bank was running out of dollars, they shorted the baht, the national currency of Thailand. On July 2nd, 1997, Thailand floated the currency and the crisis had begun. After Thailand, the panic spread in waves. Malaysia gave up defending their currency in August. Hong Kong faced the first speculative attacks in October. Korea turned to IMF in December, and by February 1998, Indonesia's currency had collapsed $10,000. And the climax come in August 1998, with Russia's default and Hong Kong's market showdown, followed by Malaysia's capital controls in September. So, we may ask a question, why does this chain reaction occurs so quickly? This diagram explains the mechanism that turned a currency problem into a regional crisis. It starts when local currency depreciates sharply, as happened when Thailand abandoned its dollar peg in July 1997. On the bottom right, here is an example. Before depreciation, $1 is equal to 25 Thailand bahts. So a $1 million debt would be worth 25 million Thailand bahts. The country could manage to repay this debt using Thailand baht revenue. But after the depreciation, $1 is equal to 50 Thailand bahts, a 50% devaluation. Now for the same $1 million debt, the company needs to spend 50 million Thailand bahts to exchange for enough US dollars to repay the debt, more than double the amount before the devaluation. Because banks and corporations across the region have borrowed heavily in US dollars while earning revenue in local currency, depreciation instantly inflated the real cost of debt. And then the firms and banks began to defaulting, which triggered bank runs and institutional failures as depositors lost confidence in the financial system. And then this forced banks to pull back lending, contracting credit throughout the economy, which in turn dragged the real economy into recession as business lost access to capital and consumer demand collapsed. The recession then drove capital flight as foreign and domestic investors pull out their money out of country to avoid further losses. And that outflow put pressure on the currency and restarting the whole cycle. It is shown by the dashed orange arrow looping back to the top. This vicious cycle is exactly why the crisis spread so quickly and violently from Thailand to Indonesia, South Korea, and beyond. Once markets saw the pattern play out in one country, capital fled from the other places quickly. Here's the data that shows the damage. Indonesia's currency lost nearly 3/4 of its value and its stock market fell more than 80%. Korea, Thailand, Malaysia, and Singapore suffered combined currency and equity collapse. These moves were not gradual adjustments. They were sudden crashes that made dollar debts impossible to service and destroy household and corporate wealth. And then the panic worked through two channels. First, investors who lost money in Thailand put capital from other countries. Second, regional banks and corporations were linked by trade and cross-border loans. By late 1997, the panic had reached Korea, and by mid-1998, it had helped trigger Russia's default. There are two defense strategies. Faced by the speculative attack, Hong Kong and Malaysia took two opposite routes. Hong Kong defended its peg by massive market intervention and punishing the interest rate. Malaysia imposed capital controls and fixes its currency, ignoring IMF advice. Both succeeded, but the contrast became the most debated policy lesson of the crisis. So Hong Kong immediately launched a defense. The government spent roughly 125 billion Hong Kong dollars buying blue chip stocks and futures. On August 28th, the final trading day, turnover hit a record of 790 billion Hong Kong dollars. The Hang Seng closed above speculators' break-even, and the tracker fund later sold a portfolio at a profit. So, in conclusion, the Asian financial crisis left three lasting marks. First, governments across Asia built up huge foreign exchange reserves. Second, they created Chiang Mai Initiative to help each other without always calling the IMF. Third, the economics learned that the order of financial liberalization matters as much as the direction. And that's it for all. Here's my works cited, and thank you for listening.